Mahesh Patil, co-CIO with Birla Sun Life Mutual Funds. Mahesh, good morning. Thank you for joining us. Mahesh, what's in store for us for the rest of the year? Because 2012 was a strong year for us. Are we in for a strong 2013 as well?
Well, 2013 we feel, last year the market actually mean reverted. Market ran up ahead of the economic fundamentals. This year we see the macroeconomic fundamentals catching up. So we see a mean reversion in a lot of the domestic macro fundamentals, whether it is the GDP growth, which hit a low of 5.5 to moderate up to around 6.25 this calendar year. Even interest rates, we expect around 75 basis point cut. And even recovery, we see some recovery on the investment side led by the government push and urgency in terms of revive the whole investment climate going forward. So this year actually we are seeing the cyclical downturn what we hit last year. We see some kind of recovery over there and reverting back to mean in this calendar year. And even from a market standpoint, while the market is now already at long-term average in terms of the PE multiple, so we saw that PE correction re-rating happening last calendar year. And this year I think the market should by and large follow the earnings growth trajectory what the corporate earnings report in FY14. And there again we believe that the corporate earnings growth, which had also lacked the nominal GDP growth last year, should again mean revert to the longer term average trend, which is around 14% or so. So that should be the kind of return I think one can expect from the market, assuming there is no re-rating. And one good thing what we see is that the earnings downgrade cycle what we have been witnessing for the last 1.5 years, that's kind of bottoming out. If you look at last quarter itself, the number of upgrades and downgrades are kind of evened out. And there could be a possibility that as interest rates go down and those get factored in terms of the analyst expectations, we could see marginal upgrades also for the next fiscal year. So if that happens, then you could see some re-rating potential in the market.
Mahesh, what's your expectation in terms of what the RBI may do this policy?
Well, we are expecting, looking at where inflation is and the fact that the government has taken measures, to really address the fiscal situation. We are expecting correction in this policy rate. A full year guidance, what we are expecting is around 75 to 100 basis point for this calendar year.
Mahesh, as of now, if I map the broader market mood, just about everyone is focusing on the good news. Good news that earnings will bottom out. Reserve Bank of India rate cut will kick in. Government action will only pick up further momentum. Do you think at the current juncture there is a lot of hope which is building in and it's a matter of time global macros or the fiscal problems they will haunt us?
Well, I think as you rightly said, I mean there is a lot of expectation in terms of things improving. I think the key risk for the market going forward, obviously the global macro currently we've seen a pretty good environment, a risk on kind of environment. All the indicators in terms of the CDS spreads for Euro region suggest that things are looking pretty okay. Even the fiscal cliff situation has been deferred for some time. So that still remains, the global macro still remains a concern, and we've seen especially in India, we are dependent to a large extent not only for the market but also for economy in terms of capital flows because of the high current account deficit what we have. So any change in that outlook and any reversal of the capital flows can put pressure on a rupee also in terms of the market. So that risk always remains. And more from a domestic fundamental standpoint, I think we are getting into a year. We have seen the government action in terms of policy, in terms of reforms. But a lot of things needs to be done at the ground level to really sustain that and to sustain the recovery for the economy going forward. And with elections in the second half of this calendar year, one has to wait and see if populism really takes over reforms somewhere down the line. If that happens, then yeah, that could be a kind of a area of uncertainty from a market standpoint.
Mahesh, as a fund house, you have a very large exposure to private banks, and rightly so because that's been one performing group. But now do you think the margin of safety incrementally lies in favor of going long on PSU banks rather than private banks, or the private banking trade will still continue for another 2-3 years?
Yeah, I think your observation is right. We have been positive on the private sector banks since more than a year, and mainly on the belief that these banks are able to manage the asset quality much better. A lot of these banks are retail focused, where there is no real concern on NPA, unlike what we are seeing in the economic downturn on the corporate side, and that's where the PSU banks are largely exposed to. But going forward, I think we think the private sector banks will also continue to do well. It's not like they will falter. They have shown a steady earnings growth, and that will continue. Probably the PSU banks now, with the asset quality cycle really bottoming out, and with some recovery expected in the economy, and looking at valuations differential between the private sector banks and PSU banks, yeah, there could be merit to really start looking at PSU banks. But again, one has to be selective, because still we feel the restructuring, or the total amount of restructured loan, that's not likely to come down sharply in the next few quarters.
So Mahesh, at the current juncture, what are your key overweight and underweight positions? And in this calendar year, how exactly your portfolio could change?
Well, our theme for this year is that we are seeing a cyclical recovery, and with interest rate cut, we'll slightly biased towards interest rate sensitive and cyclicals. And also the fact that the valuation differential between the defensives and the cyclical stocks is at an all-time high. So we expect again a mean reversion in that trade. So given that outlook, we are positive on auto, banking and financials, cement. So these are our significant weights in our portfolio for this year. And underweights would be FMCG, while consumer continues to do decent, but relatively, I think, looking at valuations and some slow moderation in growth, we think they could underperform a bit if the market returns around 15%. And oil and gas, because oil and gas, while we have seen government policy action, deregulation, but these things keep on coming up, and we have not seen a sustained policy or a roadmap for deregulation going forward. So we remain still skeptical, and even the global cyclicals, while there is immediate trade, we have seen some revival in China, but we don't think that's sustaining. So our outlook on commodities also still remains pretty weak from a medium to long term perspective.
Which means you are not very excited about the kind of sound bites we are getting from New Delhi in terms of some oil sector reforms, the fact that, Government of India or the oil ministry is considered a measured fuel price hike. That does not excite you? You don't buy that story?
No, I think while if that happens, that's good from a fiscal standpoint. But to what extent really it will mean on a sustained benefit for some of these companies, I think the picture is still not very clear, because we have seen policy flip-flops on this issue at various points in time. So given that uncertainty, we would like to really focus on sectors where at least we are sure in terms of the measures and in terms of our outlook. And so that's would be our preferred bet, rather than playing some of these policy-related companies which are dependent to a large extent on policy news flow.
What about the oil and gas space then, Mahesh? Does it seem like a diesel price hike to the quantum of what people are actually talking about is something which will actually go through?
Again, a very difficult question. I mean, I think the intentions are good. Okay, we have seen this thing also coming through earlier. Okay, oil ministry proposing, but finally the finance minister and the government has to take a stand on that, and what impact it could have on inflation going forward. So I think it's a stand which the government has to take. Obviously, if it goes through, the sector could see some re-rating over there, because the valuations are still pretty comfortable in that sector. And if there is a clear roadmap, then investors are able to value these companies much better. And there is some potential for re-rating possibility in some of these stocks. And looking at the fact that there is some offering by the government in some of these stocks in this sector, I think at least the government have to see the news flow in that sector remains good, at least for some time.
What is the best way to bet on Indian consumer this year? Are you betting on the discretionary side? Are you still betting on the non-discretionary side?
I think at the margin, I would say that consumer discretionary is something which could see some recovery going forward as we see interest rates going down. And looking at the underperformance for some of these stocks last year, I think that's a trade which would likely be positive if you take a 1 or 2 year view. Consumer staples are something which are doing reasonably well, but the valuations there are at all-time high. In fact, they are, according to estimates, they are 2 sigma above the long-term average. So any further re-rating potential from there is very, very limited. Whereas in discretionary, there is a potential for re-rating if the growth revives going forward.
Mahesh, what makes you bullish on the cement pack? Do you not think that the stocks have already run up a fair bit and therefore perhaps it's now time for a pause in the sector?
Well, cement has done well even last year, okay, despite concerns about slowdown. We have seen that because of price stability. And these companies are reporting good margins, good EBITDA per ton, good return on capital employed. And now with some recovery happening expected, I think the volume growth should start to inch up a bit. And I think after a long time, we have seen the cement sector actually reporting healthy returns. We expect that to continue. We don't see any further pressure on the cost side. And if pricing remaining stable, the company should really add to good on ROC and free cash flow generation. So I think it still remains steady. I think valuations have moved up for the large cap cement company, but still value in some of the mid cap cement stocks, okay, which could re-rate as this thing sustains going forward.
Let's also talk a bit about the appetite. Last year we've got $25 billion. $25 billion is a lot of money for Indian markets, and Indian markets, they appreciated. But this year, do you think global liquidity would get challenged? Because at a time when genuine global growth is making a comeback, maybe India could fail to attract abundant liquidity?
Well, that's a dilemma which is always there. I think relatively, if global growth comes back strongly, okay, in US or even for the matter in Europe, then the monetary easing, what we have seen by the central banks, okay, that could really halt. Though there is no immediate concern at this point in time, but that's a possibility. I'll get better picture on once we get the second quarter calendar year results for the US economy. Okay, that would really change Fed stance in terms of how long they will continue with this quantitative easing. But I think one thing is sure that globally we have seen some tilt in terms of asset allocation towards from money which was heavily in the last 2-3 years moved into the bond market. That's likely to shift towards equities because with interest rates already bottoming out and with expectation that they could move up a bit. So there is some asset allocation trade towards equities. And if that happens, meaningfully India would also get its share as a part of the emerging market economy. And so that should mean that the outlook on flows even for this calendar year should be pretty okay.